Everyone has an opinion on where to invest internationally: London, New York, Dubai. And usually the argument is emotional, the brand, the lifestyle, the familiarity. And when almost nobody does is sit down and actually run the numbers across all three. And I did that: 10 metrics, real data, and I want to show you what it looks like when you strip the emotion out. And I've been comparing these three markets for a while. I want to be clear about what this video is and what it isn't. This isn't about which city is more beautiful, more exciting, or has better restaurants. This is a lifestyle conversation. This is about where your money actually performs if you are investing. So let's go over the 10 metrics: cost, tax, yield, growth, and access. Let's go. Metric number one: what does it actually cost to buy? Before you have done anything, before you have turned a key, before you have collected a single dirham of rent, what does the government take from you just to complete the purchase? Most investors significantly underestimate this number. It is a one-off hit, but it is a big one. Let us look at London first. London sits at 5 to 12% in stamp duty alone. £1 million London flat costs you £43,750 in government tax before you have done anything. And if you're a foreign buyer, add another 2% surcharge on top of that. New York, 4 to 6% in transfer and mansion taxes. A $1.5 million Manhattan condo generates roughly $65,000 in transaction taxes and fees before your attorney has even invoiced you. Dubai, 4%. That's it. DLD on a 4 million dirham Dubai property, that is 160,000 dirham only. No foreign buyer surcharge, no additional layers, and that is the win. Equal or better headlines, but without an annual property tax sitting behind it. Which brings me to metric number two. What does it cost you every year to just own it? Transactional costs are one-off. Annual property tax is a permanent drain on your returns every year, whether you have a tenant or not. So let's start with London. London's council tax running £1,500 to £5,000 per year. You pay this even between tenants. Property sits empty for a month, the bill still arrives. New York, property tax of 1 to 2% of assessed value per year. On a $2 million Manhattan apartment, that is $20,000 to $40,000 per year before you have collected a single dollar of rent. Dubai, service charges go to your building, not to the government. There is no annual government property tax in the UAE, none. And that is the win on this metric. The only market of the three with zero annual government property tax whatsoever. Moving on to metric number three. What does the property actually pay you? So starting with the gross yield is what the brokers quote you. The net yield is what lands in your bank account. These are very different numbers. So starting with London, net yield in prime areas is 2 to 2.5%. The gross number is 3.5 to 4. Another income tax on rent, agent fee, repairs, and void periods. That is what survives. New York, net yield in Manhattan is 1 and 1.5 to 2%. Condo fees, property tax, and management costs eat the yield. Some of the Manhattan units run near cash flow break-even, meaning the rent barely covers the cost of ownership. And in Dubai, net yield in prime areas of 5 to 7%, such as Dubai Marina, JVC, after service charges and management 5 to 7% net. Chiller free buildings push past 8% as well. And that is the win. 2 to 4 times the net yield of London or New York at a comparable tier of global city. Moving to metric number 4. What does the government take when you sell? So let's say your property went up. Here is what you actually get to keep. In London, you pay 18 to 28% capital gain tax on residential property, basic rate taxpayer pays between 18, higher rate pays 28 on a £500,000 gain up to £140,000 goes to HMRC. That money is gone before you see it. New York up to 35% combined, and in practice often higher. Federal 20%, New York State 10.9, New York City 3.9. A $500,000 gain, you keep less than $325,000 of it. Dubai, zero. No capital gains tax. What you make is what you keep. Your entire gain stays yours. And that is the win on this one. Not lower capital gain tax, zero. Every dirham of profit belongs to you when you decide to sell. Matrix number 5. What do they take from you or from your rent every month? Your tenant pays the rent. How much of it actually reaches you? So let's talk about London. Income tax on rental income at 20 to 45% depending on your bracket. Basic rate is about 20%, higher rate is 40%, additional rate is 45%, and mortgage interest relief is now capped at the basic rate. So even if you pay a higher tax rate, you are still capped. New York up to 51% combined at the top, federal 37%, New York State 10.9%, New York City 3.9%. At the top bracket, more than half your rent disappears in tax before you see it. Again, Dubai 0% income tax, whether you live in Dubai or not. Your rental income is entirely yours. No reductions, no brackets, nothing. And that is the win. In London or New York, tax can cost you more than your mortgage payment. In Dubai, nothing. So let's move to matrix number 6. What does the same budget actually get you? So for this, let's say 4 million dirhams, which is roughly 870,000 pounds or $1.1 million. What does that buy on the ground? London, 1,200 to 2,500 pounds per square foot. In prime zones, 4 million dirhams buys you roughly 380 to 800 square foot. In prime postcode, a 1-bedroom apartment if you're lucky with the timing. New York, $1,500 to $3,500 per square foot. In prime Manhattan, the same budget, $1.1 million buys you 300 to 730 square feet. A studio to a small 1-bedroom in Midtown with HOA fees on top. Dubai, 2,000 to 4,000 dirhams per square foot in Dubai Marina or downtown. The same 4 million dirhams buys you 1,000 to 2,000 square foot. A 2-bedroom with a sea view. In London, the same budget is a car parking space. And that is the win. 2 to 4 times more floor space for the same money at a comparable global waterfront address. Matrix number 7. What does buying here do for your life? Beyond the return numbers, does owning a property here give you the right to live here? London, nothing. UK residency is entirely separate from property ownership. A £10 million Mayfair townhouse gives you 0 additional visa status. New York, again, nothing. The US EB5 investor visa requires $900,000 to $1.8 million into a job-creating business. Real estate alone does not qualify. Dubai, a 10-year golden visa from 2 million dirhams, that too on the purchase price, not on fully paid value. So once you have the title deed, you can live, work here and sponsor your family. No employer requirements, no renewal anxiety every 2 years. And that is the win. The only market of the 3 where your property investment also buys you a long-term residency. Matrix number 8. Where have values actually gone up since 2020? So not projections, not forecast, what the asset actually did over the last 5 years. London, 12 to 20% in prime areas over 5 years. Solid headline number. Inflation adjusted real returns were flat or negative in many areas. Outer zones underperformed badly. New York, 5 to 15% in Manhattan over 5 years. Remote work, the city exodus, and rising interest rates created a flat or negative real return environment in key segments of the market. Dubai, 60 to 120% in prime areas over 5 years. Palm Jumeirah up over 100%. Dubai downtown 70%, JVC up 50%. The market that was being called a bubble in 2022 and 2023 kept proving the critics wrong. And that is the win. 3 to 10 times the capital appreciation of London or New York over the same 5-year window. Metric number 9. What does it cost you when you want to leave? The gain on paper is only real after you subtract what it costs to sell. Almost nobody models this upfront. London 3 to 5%, state agent 1 to 3%, solicitor fee, and then capital gains tax on your profit on top of that. New York 7 to 10%, often more than 6% broker fee, 1.8% transfer tax, attorney cost, and potentially a co-op flip tax if your building has one. Then federal, state, city capital gains tax on your profit on top of all of that. Dubai 2 to 3%, agent commission around 2%. The 4% DLD transfer fee is paid by the buyer, not by you. So cleanest and cheapest exit of the three. And that is again the win. Your exit costs the least and the transfer fee is paid by the other side of the transaction. So let's move into our final metric, which is how easy is it for an international investor to actually buy. So let's not go what the brochures say, let's talk about the actual process. London, it's an open market, but foreign buyers pay an additional 2% stamp duty, surcharges from day one. The process is cleared through a solicited 8 to 12 weeks typically. New York, partially restricted. 70% of Manhattan apartments are co-ops. The board can reject any buyer. No reason required. Condos are open but more expensive. The process is slower and less predictable. Dubai, it's fully open, designated freehold zones, no foreign buyer penalty. The process is an SPA, the Uqud registration, then the title deed. Typical timeline is 30 days, and that is a clear win on the final metric. No surcharge, no board approval, no restrictions. The most accessible market of the three for an international investor. So 10 metrics, 10 wins, 1 market. London and New York have things Dubai does not. Scale, history, depth of liquidity, markets, global markets, cultural weight, those things are real and they matter for a certain investor category. But on a pure investor math, cost to buy, annual tax, net yield, capital gains, income tax on rent, price per square foot, residency benefits, 5-year growth, exit cost, and access, Dubai wins every single one of those categories. This is again not my personal opinion, this is what the data has been showing us. And if you're an international investor sitting in London or New York property and you have not seriously modelized the Dubai alternative, this is the moment to do that. Link is in the description. Bring your current portfolio and your question and let's talk further.